can be defined. So they can be able to define different kind of crimes. So which these crimes, so the audit is actually involved in such, then you can be able to say the auditor has committed a criminal liability. The offense in this case is against what? The state. It is against the state. When you actually commit a crime, so you'll have in this case state prosecutors versus the accused. So the accused here will likely be the auditor. So crimes is going to speak about of a community to bias habits. So in most of the instances, you normally see serikali inaingilia, they arrest the accused person. Anytime you've heard on the news that probably someone has committed murder, so immediately the government, the state actually swings in through the state law office, they arrest the person. The person is actually brought before the court to be answered. So that's a crime has happened. So violence, murder, all those ones. But still in the same case, we can be able to have other forms of crimes having to be committed. For example, there could be corruption, there could be issues like maybe money laundering, there could be, for example, fraudulent fraud. Fraud in Amanisha, for example, when a report is of example buy and you defraud maybe third parties. So that is also what a crime. So crimes can be defined under different laws. And of course, if an auditor is, for example, involved in such a government commits crime, and therefore in this case, what arises? Criminal liability. So that's why in this case, they are saying the offense in the case is normally what? Against the state. State law prosecutors, in this case, will end up having to, in this case, arrest the person. So the remedies of the offense include fine, imprisonment, or it can be both. So the circumstances as far in this case, for example, this one could end up having to arise. Number one, for example, allowing your name as an auditor to be used on accounts that you never audited. So for example, in this case, you participate in having to sign books of accounts or sign audited financial statements that you are not actually party to. So this is a deception under the Theft Act. You're having to, in this case, deceive. You're having to deceive. So that basically goes against what? The Theft Act. Then when the auditor knowingly and willingly makes written statement of accounts, which to his knowledge is misleading to the public and the shareholders. For example, in this case, that is what you're calling fraudulent reporting. So it is exactly what misleading. It just intends to do what maybe defraud those ones who are using the audited financial statement. So he of course signs them, but of course he knows clearly in this case, probably they actually misleading. So his intention maybe is to do what? To defraud them. Where he colludes with the management to commit or conceal what? A fraud. Maybe through what? The financial statement. So on a collude now. So they have done maybe wrong reporting, but for him as an auditor, he doesn't act independently. He doesn't, for example, reveal the misstatements. In this case, he colludes with them, whereby they convince him that in this case, he ends up having to give maybe probably a wrong opinion about it. But in this case, they actually correct or reflect a true and fair view, yet it's not actually true. If that is the case, then he has actually, for example, colluded with them, he has actually participated in fraudulent reporting. When the auditor acts as an auditor knowing himself, he has been disqualified under the Companies Act. For example, exactly an auditor of a company, yet in this case, he has been disqualified. He cannot actually be able to serve as an auditor. We say that in this case, which kind of person is not allowed to, for example, serve as an auditor of a company? We say a body corporate. A body corporate, apart from a body corporate, which other kind of person? Yes. A servant or an employee of a company, or a director of a company, or in any case, a relative, or anyone exactly basically connected to an employee or a director of a company, due to what? Conflict of interest. Maybe in this case, having to avoid what we call what self-interest having to arise. So, for example, in this case, you've gone against those provisions regarding as to who can be an auditor of a company or a relative to a director, and you still proceed. So then in that case, you would have gone against the provisions of that statute law, and therefore you can be held liable under what? Criminal liability. So when the auditor mutilates, destroys, or alters any part of the plant, the books of accounts, or maybe information regarding with the intention to cover up what? Fraud. So he destroys the documents or the documents of books of accounts, so that he can be able to conceal a fraud. So that is also in this case, a crime, the auditor may be guilty of the offense of insider trading. For example, is involved in mentioned fraudulent reporting, money laundering, or there can be another one called insider dealing. Also said destroying the books of accounts, destroy books of accounts, So insider dealing or maybe insider trading. So is another reason. Insider dealing is whereby, for example, you take advantage of inside information, material inside information that is likely to materially affect the prices of the shares of that company when the information is actually made public. So when you talk about, in this case, insider dealing, for example, it could be maybe you are the auditor of Safaricom, and of course, now in this case, you know Safaricom is likely to make an announcement of their expansion into the region. So the information is actually yet to come public. But what you do in this case, you buy the shares of Safaricom, knowing that when they make that announcement or public announcement, the shares will rise. And of course, now in this case, you'll benefit. So if that is the case, you'll be involved in what you call insider dealing. So this one is actually regulated under the CMA Act. And therefore, in this case, it is a crime to be involved in what you call insider dealing. Or you can do the opposite. It is negative information. What you do, you sell them. You don't buy, but you sell them off. So if that is the case, that is insider dealing, or the auditor, because the auditor is one of the insiders. If you're auditing Safaricom, you know more about Safaricom. Probably you are attending board meetings, you can be able to hear maybe through the corridors that is actually going to happen. So what you do, you take advantage of that information before it becomes public. Because if it becomes public, if the prices of Safaricom on the stock exchange were going for, let's say, for example, 12 shillings, then they make the announcement that they're going to, for example, acquire the markets of Uganda and of course Rwanda. You realize the next day the shares will probably be going at maybe 15 shillings, maybe at 13 shillings, maybe 13.5 due to that announcement. But you took advantage of it, you bought them at 12 before the announcement, then they have risen to 12.5. So the reason as why in this case this one is actually regulated is because these are part of the reasons that in this case some of the companies could end up having to go under, especially when in this case it is the opposite, where we have a massive exit of the major shareholders having to sell off their shares, because now in this case eventually there will be a drop in the price, If the auditor also participates in such, then that is a crime, and of course a criminal liability can arise whereby you can be penalized or actually be fined. You can be penalized or maybe be fined. Then to say insider dealing or insider trading, then when the auditor knows or suspects any person has engaged in an act that are prejudicial to the public interest and doesn't report the matter to the relevant authorities, for example, money laundering or maybe treason. So if that is the case, then if the auditor keeps to himself, we're going to see what is money laundering and why in this case it is important to the auditor. If the auditor keeps to himself, then, and it is discovered later it was the auditor of that kind of an entity, then criminal liability arises, and because it can actually be accused of such. Then we have civil liability. Civil liability arises majorly due to what we call negligence. And negligence, of course, there has to be 3 key elements to be proved here. Number 1, that the auditor had a duty of care. The auditor had a duty of care. The auditor had a duty of care. Number 2, the auditor failed. For his duty of care. Number 3, as a result of this, those are financial loss. Occur. So therefore, in this case, if the client himself or maybe any third party can be able to prove this, then of course arises what we call negligence. Negligence is actually a civil liability. So remember, under criminal liability, it is the state prosecutors against what they accused. But now here, it's just between what the individuals. If it is a third party who suffered the loss, is the one who sued the auditor, not the state. Because in this case, for example, for insider trading, the matter will be taken up by the Director of Public Prosecutions. He likely prosecute the auditor. But in this case here, you just committed a wrong against what? A fellow third party or a fellow individual or a fellow private citizen. So, and of course, in that case, it will be negligence, which is civil in nature. Therefore, civil liability does what arises against the auditor. So the major liability here under civil liability is what you're calling what? Negligence. For negligence, these three have to be proved for the auditor to be sued. Because what you sue in a court of law, as a third party, you say, I was actually basically relying upon the auditor's duty of care. What is the duty of care? The duty of care of the auditor is to undertake an independent examination of books of accounts and express what? An opinion. So if he fails in having to, for example, undertake this independent examination as per the requirements, or as per the standards, or as per the framework, it simply means that he would have failed on his duty of care. And of course, you as a third party would end up having to suffer what we call what? A loss. How does the loss actually arise? Let's say, for example, you know the users of the financial statements. Remember what we learned about an assurance engagement. That it is a three-party. That in this case, we have the professional accountants, we have those who are charged with governance, and we have the users. So the users here, we can be able to have in this case the client himself having to use it. We can be able to have in this case maybe lenders of money. We can be able to have in this case investors. Investors or any other relevant third party. Any other relevant third party. So they are basically placing a lot of reliance on your work. Once it is finished, they will rely upon it. Let's assume this lender relied on their report, the audited report, to do what? To lend the money. Then, of course, once he lends money, that report was actually misleading. He lost his money. In what sense? For example, in your report, you would have been able to bring out that in this case, this company, this particular entity is not actually performing so well financially. But in this case, your audit report indicated that in this case, it is performing so well. This is the one actually convinced this one to lend the money. So we can eventually later on sue you under civil liability, under negligence for your failure of duty of care, of ensuring you portray or give out a good report or proper report concerning what the audited financial statements. For example, it would be this investor. This investor relied on what the report to understand the stability in terms of performance of the reporting entity. But in your report, you as an auditor, you failed on your duty of care. You didn't actually, for example, in this case, undertake your work as expected as a professional. You didn't actually undertake what we call professional due care. Professional due care. So as a result of that, the report, in this case, misled this investor, you invested this money, then you have your money. So that is a loss that has been suffered as a result of what? Relying on your work. That is negligence. It takes you to a court of law, sues you for negligence, and therefore civil liability would have arisen against what? The auditor. So this arises under the normal law of what? Contract. When the auditor accepts appointment as a statutory auditor of a company, he enters into a contract with the company as a body and not with what? With the individual shareholders. So what exactly happens here? So the contract has both implied and expressed terms. The implied terms of a contract is that the auditor will exercise professional skill and due care. Will exercise what? Professional skill and actually what? Will have a duty of care. Then, if however the auditor fails, if the auditor failed on his duty of care, in the audit of the financial statements, he will be negligent. On zero, he will be what? He will be negligent. And this one will end up having to cause what? A financial loss. So if these ones can be proved, then negligence arises, then civil liability would have arisen. Civil liability would have arisen. So then the company can sue the auditor for damages under the law of what? Contract. For the company to succeed against the auditor, she must prove, the company should be able to prove. So these three key elements are very important to prove for you to succeed to sue in a court of law. So number one, a contractual relationship existed. We should prove that, which is automatic. The auditor owed the client a duty of care. Number three, The auditor breached or failed on his duty of care, therefore it was negligent. As a result of that, the company suffered a loss due to the breach of the contract. And in this case, there was a loss which is actually quantifiable. There was a financial loss which is actually quantifiable. So, and of course, there was a direct cash relationship between the loss suffered and the auditor's what? Negligence. So the loss suffered is actually in connection to the negligence of the auditor. Therefore, as a result of that, civil liability arises, which we can specifically call what? Negligence. We call it negligence. So the concept of negligence, so the auditor is said to have been negligent. For example, how does a failure of duty of care arise? So you are a professional who basically has been trained, has the knowledge. Before, for example, you start practicing this trade, you know what is actually part of you. For example, if you're having to undertake this kind of work. So it simply means that you must be able to undertake the work by having to observe, for example, the relevant what frameworks. If you don't observe them, then you fail, you have a duty. Yeah, by having to observe what the relevant framework when you're having to undertake the work. But if you do the opposite or contrary to what the framework requires you when undertaking that work, that's duty. Because any other auditor in the same capacity, you should have been able to do what? Follow the relevant guidelines and frameworks of having to do what? Undertake the work. But usipofanya kama vile auditor mwingine anajua kazi yake amefanya, you have failed on your duty of care. And of course, eventually that is ending up having to lead you to what you're calling what? Negligence. And of course, what? Civil liability. So for example, when the auditor fails to follow what he says in the audit of financial statements. Number two, failure to detect material misstatements in the accounts. That is your major role, that is your major role as an auditor. Detection of what? Misstatements. But if you didn't actually, for example, undertake that to detect them, then what were you doing there? Your kazi yako, your duty, hauangalii duty yako. So we are not actually looking after your duty. In carrying out their duty, they did not exercise reasonable care skill expected from what? A professional accountant. You know, tunasema any other professional accountant in the same capacity, there's a way he could have been able to conduct himself as a professional by deploying the relevant knowledge, skills, and actually experience gained through the trade to be able to undertake what they are assigned. Like, you know, ulifanya tu your own things. So as a result of that, negligence arises, and of course, as a result of that, civil liability would have arisen against the auditor. Then you have liability under the common law, so against maybe third parties. So the auditor doesn't have a direct relationship with, of course, what third parties. He has no contractual relationship with the various users of the audited financial statements, other than the company as a body, and not with what individual shareholders. But in this case, under the common law, so the third parties, they are now these ones. Lenders, those are the third parties. They're not the clients directly, but still he has a responsibility to what? The lenders, the investors who are third parties, not within what the client business. So, however, under the law of torts, everybody owes their neighbor a duty of care. According to the law of torts, your neighbor is anyone who may be affected by your omission or commission. So these ones become what? Neighbors. They can be affected by what? Your omission. They can be affected by what? Your omission. So therefore, you have a duty to fulfill for them. So based on this definition, therefore, the auditor may owe third parties a duty of care, since third parties rely on what? Audited financial statements. If a third party suffers a loss as a result of relying on the financial statements that were negligently audited, the third party may sue the auditor for what? For damages. He may sue the auditor for damages. So he acted negligently, and of course he can be able to prove these three. So under the common law, in this case, he's actually allowed to sue the auditor for that civil liability that was actually arisen. So, but for him to succeed against the auditor, he must prove the following. Just the same things we went through. The auditor owed him a duty of care. So, the third party should prove that the auditor was aware of the transaction to be executed and that he was going to rely on the audited financial statements. Then number two, the third party suffered what? A loss. He suffered a loss, which is quantifiable in monetary terms. The duty of care was actually breached. Can just be able to see the elements as they come in, which eventually brings us to what we are calling what? Negligence. So there was a direct household relationship between the loss suffered and the auditor's what? Negligence. Auditor's negligence. So under the common law, in this case, still the same case, third parties are actually protected against what you are calling what? Maybe negligence having to arise. Negligence having to arise. Negligence having to arise. Negligence having to arise. So that is basically as far in this case, these liabilities could actually end up having to come up. So we have criminal liability, civil liability, then you have in this case the common law, auditor's liability under the common law. Or we can in this case, for example, have this liability having to arise. It might not actually be in this case necessarily criminal liability, but under any statute, can you also be able to categorize these liabilities as statutory liabilities. For example, if the auditor breaches any statute giving guidance as to how he's supposed to perform his work, which might not actually so much be necessarily a crime, then that statute can still actually hold the auditor to be liable. So in this case, you can also categorize as what maybe statutory liabilities. So you've already been able to see that in this case, we auditor as Pochunga machine learning in terms of liability. So how can the auditor actually try to avoid these liabilities, or how can he actually end up having to avoid continue? So how the auditor can avoid the liability? So how the auditor can avoid liability? So we can be able to look at in this case restricting or limiting the auditor's liability. So you check the next page there, restricting or limiting the auditor's liability. Restricting or limiting the auditor's liability. I don't know if you can be able to say that first. Mayona. Go to the next page. Restricting or limiting the auditor's liability. So these liabilities we've just been able to talk about. These are ways this auditor can actually be able to restrict or maybe limit them. So the ways he can be able to ensure he has been able to restrict or maybe limit them. Number one, what he can be able to do, he can take a professional indemnity insurance cover. Take professional indemnity insurance. Take a professional indemnity insurance cover, which covers also third parties. Which covers third parties too. Which covers third parties also. So to indemnify simply means to compensate. So it's one insurance, then you incur a loss. Insurance so inakulipa hiyo loss yenye umeka. So of course, as you are saying, you can be able to see what we are trying to say, that the auditor has a responsibility even towards third parties. So those third parties, as you are saying, that lender would end up having to lend the money. Maybe amepeana kwa huyo client, amepeana like 30M as a loan. And part of what he relied upon to get that confidence to lend the 30 million was the auditor's report. The auditor's report, the performance of the reporting entity or maybe client is actually so good. So the lender got a lot of confidence from the auditor's reports. So he ended up having to lend 30 M. But eventually, after one or two years, the reporting entity, or basically in this case, the client went under, or was actually liquidated, and of course, in this case, was actually declared to be bankrupt. So that means the chance of having to recover that 30 million is not there. So who basically caused this lender to lend the money? It was the auditor. So he basically calls upon this auditor to do what? He goes to the court of law, he sues the auditor, he succeeds. And of course, the court declares that in this case, the damages incurred with regards to the loan should be paid by the auditor. The auditor will never continue. So your loss from a part of 25, the 30, I'm at 25M, I'm measuring for 5M. The loss from 25 to 25M. So they call upon the auditor to pay. So if he doesn't have an insurance cover, it simply means if he has an insurance cover, the insurance company can decide they end up having to pay what, the 25 million. So they actually come in handy to save the auditor from having to, for example, incur such kind of what, a loss. So the professional indemnity insurance cover, which can also be able to cover what, third parties like that lender we are having to talk about. But now in this case, this one can end up having to have some advantages or disadvantages. Part of the advantages, it provides funds for innocent party to be compensated for a wrong having been done against them. So this third party innocent party, the lender, will be compensated, of course, by the insurance company. So it serves the situation. It provides protection against bankruptcy of the auditor. Because in this case, if the auditor is declared bankrupt, he cannot be able to pay the 25 million. So atapoteza assets zake zote. His practice, he could end up having to lose the all of it. In the head offices, will basically be taken over, be seized by the receivers. So it actually basically serves the situation whereby the auditor could actually be declared to be bankrupt. But of course, it has disadvantages. Part of the disadvantages, it is very costly to take an insurance cover. For example, in this case, each and every year, probably you have to pay a premium. Or maybe each and every month you have to pay what? A premium. So it can be a costly exercise. It can be a costly exercise. That is one of the disadvantages. Then it can end up having to lead to the auditor not having to, for example, be very careful. So anafanya tu kazi yake tu bila kujali because anajua kuna insurance cover. So hata huyo third party akipata report ni mbaya, ampeleke kotini na waeke loss, unajua insurance company italipa. So he doesn't basically, for example, take his work seriously as an auditor. He'll end up having to do what? Take less care. So that duty of care we are trying to talk about, haitakuwa sana because anajua there's no problem. The need for a liability arises. I know I have my insurance company, so they can pay for that loss. So there will be less care, but in this case, will be deployed by the auditor in undertaking his work. So every insurance policy has what? A limit also. So in this case, it simply means that they can only be able to cover up to a particular extent. Then it may encourage auditors to take less care. It increases the operational cost of the audit firm due to payment of premiums. Due to payment of what? Premiums. Then alternatively, what also you can be able to do to limit or reduce your liability as an auditor, you can decide to go for an out-of-court settlement. Even though in the zone of voting, at the time of news, out-of-court what? Settlement. Out-of-court settlement, normalization chini ya maji. Because in this case, if the matter proceeds to the court, it simply means that it will be out there in the public. So now you are the audit firm, Melza and Associates audit firm has been sued. It is all over news. You can imagine how these matters of court cases normally happen, like here in Kenya. So what I was thinking on as a televised, wanaweka live, ukienda online, wameweka, wanasema Melza and Associates is actually involved in having been involved in what a liability like this and this. So that simply means that no one can end up having to bring work for you to be able to do out of a client of the portfolio. News kila wakati, so you are easy. So it doesn't actually basically take a duty of care. It doesn't, for example, in this case, concern himself in terms of having to undertake his work as an auditor. So recently we just had in the news that this case, for example, is involved in what? A very serious case involving what? A liability. So you can go for the option. Let us just do what? Settle easily to Chinyamaji to, in this case, out of the court. So the auditor here negotiates with their agreed with the party. That is the third party, or the any party. They settle on damages without going through the court process. The advantages, the auditor avoids advanced publicity. Then, of course, the auditor avoids expensive litigation costs. Because after lawyers who make in town, who make guys who are paid, so you actually avoid those kind of costs. Then a lower settlement figure can be negotiated. So mnaweza nego sasa. Mnaweza nego kiwanaume. So mnaweza nego kiwanaume, agree. In this case, it was the damage was actually made. In this case, this amount you can negotiate so that it reduces. The disadvantage is the final responsibility is left undetermined. So hapo unajua mnafanya out of the court. So kuna ngori ya kurukana. So watu wanaweza rukana. So you had agreed, you negotiated back to from 30 million to 25 million. So you agree you're going to pay maybe in the next maybe 4 years. So the first year you are supposed to pay 5 million, 5 million, 5 million, then the final year 5 million. So auditor analipa ya kwanza, kama ya pili anadilitali, and kuna dili inaiba. So just wait. So like that. So of course now in this case, there's no one who's actually bound. Like no, in this case there is a court order. Kama ilienda kotini, then there's a court order. Lazima ufuate mambo ya koti inasema, because if you don't follow, there can be repercussions. So in this case, final responsibility is actually left undetermined. Then the third party may not be fully compensated. Then the reputation of the audit firm and the profession may be tainted if settlement figure becomes what public knowledge. Then it may encourage auditors to take less care. So they'll be less careful in terms of having to take their work. Then the next way you can be able to deal with this kind of liabilities when they actually end up having to arise, or you can be able to, for example, avoid them or limit them, is, for example, having what we call a liability cap. Liability cap in the agreement or contract with the client. Liability cap. Liability cap. Yani una cap your liability. Una step through, you can be responsible up to a particular level. You can be responsible up to a particular level. For example, in the date of engagement or contract of agreement, to undertake the assignment, unasema that in this case, I can only be responsible for a liability up to 3 million. You capped it here. You may cap up to only 3 million, beyond which I will not actually be responsible. So in that case, you try to do what limits. You try to limit or restrict that particular kind of what liability. But this one, it has a number of disadvantages. There's a number of disadvantages. One of them could be, for example, so well-established audit firms could end up having to set very high caps. And therefore, in this case, it can lead to unhealthy competition in the audit profession. So these audit firms, ziko sawa, chapa, so ziko sawa kifedha. So anakwambia liability cap yetu si tumeka 20M. So Njiru has just an upcoming audit firm, so I only be liable up to 0.5M. So client atendea mgani? Atendea what? Trade. So this one can be able to bear more liability. So it basically creates unhealthy competition, and of course, if that is the case, then small audit firms would end up not having to be able to do what? Survive. Cannot actually end up having to survive. Then another one is that these liability caps can end up having to make the auditor still to be so much less careful or take less care. And therefore, the level of confidence that can actually be placed on the kind of report they release wouldn't be so high. Because in this case, someone having to rely on that kind of an audit report, he knows that in this case, the auditor who dealt with this kind of work and make a cap of liability of 20 million. And I do auditor and maybe ask for serious na kazi. Kama angeza lipa 20 million kama liability ingetokea, sasa alikuwa anafanya nini hapo? Alifanya tu shoddy job. Then of course, in this case, he did what? He gave out the report. So we can be able to have these limits having to be set by the auditor, or is having to be agreed by the client. So these are limits agreed upon between the auditor and the client. Regarding the amount, the auditor will pay the client in the event of what? A successful litigation. The implications of this, it will encourage auditors to take less care because of the lower risk exposure. Then users of the financial statements will have less confidence in the auditor's work. Then it will force the audit fee in the market downwards, as clients will argue that the auditor is not taking on a risk. So also client that come on whom set 0.5 million as the liability cap, then the audit fee make it come as 3 million. So another kwambia, since your need is too low, then hii fee inafaa to negotiate. So kama ni hivyo basi uongeze liability, another kwambia uongeze liability cap. Ama kama si hivyo, kama umekuwa audit kama 3 million, sababu unapea liability kidogo, sasa tunaanza to negotiate na kukutana juu ya fee, because there's exactly what a liability cap. So it can end up having to create a situation whereby the audit fee in the market actually goes down. Then it will create unhealthy competition in the audit market, since audit firms will be able to put a higher cap. Established audit firms will be able to put a higher cap compared to what small audit firms, and therefore create what unhealthy competition amongst the audit firms. Then another way of how you can restrict or limit these auditors' liability is having to operate as an incorporation. as an incorporation, operating as an incorporation, whereby you come up with the what we call, come up with what we call an LLP, limited liability partnership. So these are kind of a partnership that has elements of a company, at the same time, elements of what a partnership form of business. So whereby there's a limitation in terms of the liability that each and every partner can be able to bear. Because in this case, majorly assignments in audit firms are normally undertaken by engagement partners. And because they're the ones who end up having to do what? Sign the audit report. So if all of us have like an LLP, whereby the limitation in terms of liability has already been stated, although it is a partnership amongst all of us, it simply means that that engagement I'm actually involved in. Wanjiru. Because Wanjiru was not the one who was involved in the engagement. So there's actually a limitation in terms of what the liability all of us as partners can be able to bear. So in this case, you operate as an incorporation that has what elements of what a partnership, whereby you register the audit firm as a limited liability partnership, whereby each and every partner will be able to bear what the responsibility in terms of liability. In that case, for example, it was what the engagement partner in an assignment. And then number 5, providing joint and several liabilities. Providing joint, providing and several liabilities. Providing joint and several liabilities. So the auditor can share liability with the directions of the company by providing a joint and several liability. So the directors of the company have a statutory obligation to force the company to prepare financial statements in line with the identified financial reporting framework and ensure that they are free from material misstatements. So in this case, you just clearly indicate on which kind of liabilities in this case you can maybe be jointly be held with the reporting entity, or for example, in this case, on which kind of liabilities you'll independently be held liable. Maybe in this case, the company itself or the client itself will be held liable. Because in this case, they are part of the responsibilities that are normally involved. So the 3-party relationship, in this case, we're talking about the professional accountant, the management or the directors, then of course you have the users. So the management, or those ones charged with governance, they have that responsibility of having to do what? Prepare the financial statements. So in this case, clearly in your letter of engagement or contract, you can clearly outline the responsibility of each and every party, whereby clearly you indicate that I was not the one who prepared these financial statements. It was only just my role to do what? To review. In case there is actually any liability arising in connection to the preparation of the financial statements, you see related. But in this case, you bring an issue concerning what? Review. So clearly having to indicate your liability or maybe your responsibility when you're having to undertake that kind of an assignment of an auditor can save the situation whereby if there's actually any third party or any other party having to accuse you of what you're not actually involved in, then in this case, you can be able to do what? Limit your liability. Clearly having to come out what is actually your responsibility, what can you be jointly held responsible with the client, and what in this case, which kind of liability you likely basically be independently liable. So these are just the major ways, but of course you have others. If you look up there, litigation avoidance, you can be able to see them. Also, those ones you can be able to mention them. Litigation just after it, or restricting or limiting, before restricting or limiting just up there. Litigation avoidance measures. So also those are ways as far in this case you can avoid that liability what to arise. For example, what you can do, you can do proper client screening before accepting the appointment. So you know, for example, the kind of client you're having to deal with before you're having to go get what appointed. In this case, for example, there's something we've been able to mention. There can be the issue of maybe money laundering. So clients are involved in matters of money laundering. But tumesema, if exactly money laundering, you're supposed to report to the relevant authorities. If you see any sign of money laundering, you're supposed to report to the authorities. Like probably this client is involved in what? Money laundering. But if you do proper client screening, then you can identify those kind of signs quite early. So to avoid any blame having to arise, whereby you dealt with a client who was actually involved in money laundering, then early client screening procedures can actually end up having to do what? Save the situation, can actually avoid you having to be taken to the court. Avoid having to be taken to the court. Then following the ESAs in the audit of financial statements. So following the relevant frameworks can also in this case help you ensure that you undertake the procedures to the latter, and therefore that duty of care would have done what would have been observed, and therefore in this case the chance of having to be taken to a court of law to become a litigant will likely be reduced. Then stating in the report the work carried out, work not done, and any limitations to the work. So clearly outline your report. What was the kind of work you're having to carry out? Your report is actually based on which kind of work. Can also be able to assist you as an auditor to avoid what litigation. Then by setting in the report the purpose of the report and that it may not be used for any other purpose, e.g., putting a disclaimer. So you can be able to also put disclaimers in the audit reports, whereby you clearly indicate this report was for the purpose of fulfilling this kind of what an objective intended by the client, and that is what I actually focused on. So if anyone basically brings any other issue beyond that disclaimer, then it simply means that you cannot actually be responsible as an auditor. Then by instructing the client to obtain your permission before using your name and denying the permission where appropriate. Then attaching other appropriate disclaimers where necessary. Then implementing quality control procedures in the audits. So quality control procedures, you just ensure quality in your work. For example, ensuring, how can you be able to ensure quality? You need to ensure quality or in your work by ensuring that in this case, for example, the staffs that are involved in the audit are actually competent. They are very competent. You can also be able to ensure quality in your work by ensuring you deploy the most appropriate audit procedures. The most appropriate audit procedures in terms of even having to do what? Gather evidence. Most appropriate audit procedures. You also be able to ensure quality in work by having to undertake what you call as maybe reviews of your work. You do reviews of your work before you release the audit report. So these ones then there would be some kind of element to what you call quality in work. And of course, in any case, there could be an area you are not actually keen about that would lead to a liability. You can discover it. You can discover it by ensuring quality in the kind of work you're having to do as an auditor. Then continuous training of your audit staff, that one basically also enhances what competence. When in this case they are competent, they do a good job. So they won't end up having to give what our own opinion or our own report. And as a result of that, liability could occur CIC. Identifying the authorized recipients of the report in the report, then carrying out audit reviews as we've been able to indicate, which also enhance what quality in your work. So still, those are actually basically ways as far in this case you can avoid litigation having to arise. So if the examiner asks for more points, you can still add those ones. Because you have in this case professional insurance, indemnity cover, out of court settlement, liability caps, operating as an incorporation, i.e., like a limited liability partnership, providing a joint or several liability by clearly indicating what could be your responsibility, what could be your liability, or what will you be liable for, together with the client, or for example, individually, you as the auditor and individually the client himself. Then undertaking all those measures that I mentioned up there also, they can end up having to help you reduce having to be called upon to be responsible before a court of law, or in this case having to be accused of any form of what? Liability. Any form of liability. So that is as far in this case the auditor's liability arises, would end up having to arise, would end up having to arise. But of course, in this case, we have the regulators, for example, in this case, ISPAC. So ISPAC, or for example, the professional bodies, also try to help auditors or maybe professional accountants in their professional development, whereby, for example, they provide continuous professional development. Sometimes you've heard that members of ISPAC have gone for training in Mombasa, they have gone where. So that is basically just to continually improve them in terms of their skills and actually knowledge So with that, then they can enhance what we call quality work by auditors. And then in this case, also enables them to reduce what liability having to be incurred by auditors. So measures put in place by professional accountants bodies to minimize litigations against what auditors. Issuing audit standards on actually what guidelines. The guidelines are maybe the frameworks which you've already been able to see. If you follow them, then in this case, you would undertake your audit work so well. Issuing and enforcing compliance with the professional code of ethics. So the professional code of ethics, which are going to see, look at them, matters integrity, matters professionalism, matters objectivity, matters independence. So also those ones, they actually contribute to having to avoid any form of liability having to what to arise. Use of disciplinary committees. In a case, for example, you suspect you are a registered accountant or a practicing accountant or maybe auditor. And in this case, probably you've been involved in any matter that is actually contrary to the set code of ethics. They can call upon you to go to the disciplinary committee. You actually explain what could have happened. Then in this case, control the issue of practicing certificates. So through that, then of course, they try to regulate the profession and of course enhance the kind of quality of work that is actually undertaken by the professional. So in this case, the regulator plays a key role because in this case, if the profession is not actually regulated, so there are no standards, there's no that disciplinary committee, there's no professional code of ethics to observe. So if it's actually done haphazardly, then auditors won't actually even care. They'll just do their own work. And as a result of that, a lot of liabilities can actually end up having to arise. So that's basically what happens with regard to the auditor's liability. So I want us to look at consideration of laws, that is ISA 250, consideration of laws and actually regulations. So what are you supposed to know about considerations of laws and actually regulations? So there's something we are trying to mention that in this case, there's a framework that you can be able to observe as an auditor. There's a framework you're supposed to observe as an auditor. That is the International Standards on Auditing. So they actually guide you. But what shouldn't actually escape your mind when you are given an assignment, it is that we have different kind of laws and regulations that could end up having to guide you as an auditor, or alternatively, these laws and regulations could be affecting the reporting entity. So the reporting entity is the one that in this case you're having to undertake an audit on the reporting entity. This reporting entity actually operates in an industry, in a particular industry. That industry is actually regulated. That industry is actually regulated. This is what they are supposed to be able to observe under the laws. It is exactly regulated. So for example, in this case, it is a hotel. So hotels are supposed to, for example, in this case, comply with a number of statute laws or regulations, whereby before you operate as a hotel, you need a licensing from, is it for health, and any other relevant licensing from maybe the tourism board, whereby they end up having to pay levies. So the regulators having to regulate different kinds of industries. It is actually a school, in this case, probably, let's say, for example, it's an education institution like RCM. It has a regulator, so the TBETA. It has a regulator, what is better. So there are those compliances that you should be able to meet regarding the regulator. Of which, now in this case, if they don't actually comply, there can be repercussions. Of this, there can be certain effects. So what you're supposed to know is to understand these regulations. And why are we emphasizing for you as an auditor to understand these regulations? You'll be able to know, for example, how these regulations could end up to have an effect on the financial statements. Let's say, for example, now in this case, if you don't actually comply with the regulator, probably you can actually be fined or be penalized. You don't have that help certificates as a hotel, you can end up having to be fined or to be penalized. So what you go there, for example, you call a contractor to take an audit on a hotel, so an audit on a hotel. So of course you'll be able to consider other matters, but in this case we are emphasizing on you having to consider what laws and regulations affecting that what hotel. Part of it, we're just having to say what maybe it would be that licensing. So in this case, you look at the regulator regulating hotels. It is actually calling upon the hotel to ensure it has a certain licensing for it to be able to operate. And in this case, you should be able to, for example, have certain standards in terms of the kind of food that they're having to do what maybe give the customers, maybe the clients. So have they actually complied? Because if they haven't actually been able to comply as per that regulation, it simply means they can be fined, or maybe in this case they can be penalized, or for example, they can be closed down. They can close down, or they can actually shut down. Because this one affects what the going concern aspects. It affects the going concern aspects. So in this case, you realize that in this case, our artists or licenses, it simply means that kuna kitu inaweza tokea in future. Either wanaweza wafunga ama easy fine watakuja incur an expense in future. So you need to be able to confirm, for example, have they provided for this kind of fines where in the financial statements. Kama ni going concern, na kuangalia kwa financial statements kama wameindicate going concern as what an issue. In this case, if you look at I think you've done this one, you're doing financial reporting. Have you done published accounts? Not yet, right? You'll be told that in this case, under published accounts, or according to IAS 1, the presentation of financial statements involves you having to come up with income statement, having to come up statement of financial position, having to come up with, for example, statement of changes in equity. Apart from that, there's usually what we call notes to the accounts, or what we call disclosures. So kama kampuni iko na issues kwamba in future wanaweza kufungwa, that is a going concern issue. Going concern is simply the assumption that in this case the reporting entity will be in existence for the foreseeable future. But if it is actually doubtful, you're supposed to indicate it here, the person who having to present the financial statements. So kama wajalipa hizo licenses wanaweza kufungwa. Hiyo biashara itakuwa in the next like 1 or 2 years. And remember, as you are reading the audit report, kuna watu wanategemea hiyo report sana. Mimi nataka kuinvest kwa hiyo hotel. So if, for example, you don't actually observe having to look at this one, which is actually having to arise as a result of the regulations, which you will not actually, for example, considered, then it simply means that what you'll end up having to, for example, present as an audit report won't actually basically show what a fair presentation has actually been done in the financial statements. So therefore, the essence generally of just having to understand the regulations affecting the entity you're having to undertake an audit on. So once you've been able to, for example, understand the regulations, you look at how these regulations are likely to affect the presentation of the financial statements. If they have an effect, if you look at the presentation of the financial statements, wale walitengeneza wameobserve kama ni going concern, wameandika hapo. They are not actually, for example, put you can go to question why they are not actually provided for such. And as a result of that, it will give you a guidance. So you prepare audit report, lazima uta highlight. Umeangalia going concern, hawajaindicate hiyo biashara ina licenses, ina license, wanaweza fungwa anytime. So that simply means that the going concern of the reporting entity is actually doubtful. It is actually very doubtful. So in this case, you have to look at or consider the laws and actually regulations affecting the reporting entity as an auditor. So if you look there, they are saying the auditor is required to determine the effect of the client's compliance with the laws and regulations on the financial statements. So that basically elaborates what I've just tried to say here. Anaangalia zile sheria zinaaffect hiyo kampuni ana audit, anaangalia wame comply. Kama waja comply, what is their effect on what has been presented where in the financial statements? The auditor should obtain an understanding of the entity's environment. So we'll be looking at planning for an audit. The major thing you normally do initially is just in this case to be able to understand the environment or understand where this particular entity is having to operate from. So understanding the legal and regulatory framework applicable to the entity, unaangalia ni sheria gani hiyo kampuni inafaa kuoperate under. Maybe kuna Companies Act, maybe kuna the Health Act, kama hoteli kuna the Health Act, kama ni shule kuna the Education Act. Unaangalia those laws how they basically affect what the operations. Obtain understanding of how the entity is complying with that framework. Jaribu kuelewa comply. For example, the licenses wako nazo. For example, in this case, if they're supposed to be remitting reports or accounts annually to the regulator, are they doing it? The effect of the non-compliance on the financial statements. What is the effect on the financial statements? They are, for example, in this case, not actually been observing the requirements of the regulator. What is the effect? It is affecting the going concern. Is affecting future contingent liabilities. So the auditor should obtain a sufficient appropriate audit evidence regarding compliance with the provisions of the laws and regulations that have a direct effect on the financial statements. The auditor should perform the following audit procedures to identify instances of non-compliance. So inquire from the management and those charged with governance as to whether the entity is complying with such laws and adequate regulations. That's a reason. Anaishaelewa the laws and regulations. They need to have this kind of licensing. And I will listen, do you have the license from this particular regulator? So if it is not there, for example, he finds out what could be the reason. You can also be able to inspect correspondences with the regulator that have been happening. Then during the audit, the auditor should remain alert to the possibilities that other audit procedures that will be applied may bring out instances of what? Non-compliance. Then kama amerealize kuna non-compliance, what is the procedure? Already ashagundua kwamba hawana hizo licenses and wana operate too. So what will we be able to do? Audit procedures when non-compliance is identified. Number one, obtain an understanding of the nature of the act and the circumstances in which it actually occurred. Number two, obtain further information to evaluate the possible effects on the financial statements. What we are saying about the going concern. Then discuss the matter with the management and those charged with governance. Consider the effect it has on the financial statements. If the effect of non-compliance is material, consider obtaining a legal advice. Then if sufficient information about the non-compliance cannot be obtained, the auditor should evaluate the effect it will have on the audit opinion, or what it will end up having to express what in the audit report. For example, kama hawajaweka hiyo going concern issue, the lack of licensing. So in this case, ataangalia what will be the effect it will have on the audit opinions. So the audit opinion, I think we'll be able to look at them later on. So you can, there are just two major kinds of audit opinions. You can have modified or unmodified. Or unmodified. Or unmodified. So unmodified is a good one. So that's why it's a good one. Modified is a bad one. It's a bad one. It's a bad one. So in this case, if they are not actually, for example, in this case presented the disclosures concerning the going concern due to non-compliance with the regulations, then a bad one. That's a modified. I give a modified opinion. But in this case, for example, they include that, then there's a fair presentation of the financial statements. So you will actually do what? Unmodified. Or give a good opinion, So the observant will actually having to confirm whether the regulations have actually been observed by the reporting entity. The auditor need to be able to look at the repercussions it has on what? The financial statements. Then at the end of it all, you can be able to know how you'll be able to do what? Maybe express his opinion or give his audit report. So there's a requirement that in this case, under ISA 250, the auditor considers laws and other regulations affecting the reporting entity. Affecting the reporting entity. Then there's money laundering, I think, which I've already been able to elaborate a bit, but in this case, you can just be able to look at money laundering. Why is it happening? Very important. So I think money laundering, so I think you must have heard about the term. So it happens, there are 3 stages of money laundering. So number one is what we call placing. There are 3 stages of money laundering. There's what we call placing. Number 2 is layering. The number 3, what happens is integration. Money laundering is where someone gets money illegally. Then he tries to disguise. Like he has actually gotten the money honestly or through honest means. For example, it could be process of crime. Maybe it is through robbery. Maybe it is through maybe drug trafficking. It will be through maybe corruption and legal pesa kwa government. That's what's allowed. it is through corruption. So once eventually he gets that money, what he does, he places the money into a financial system, then he layers. So layering is like this. My handwriting is very smart. Layering. So layering. So he places the money into a financial system, then he layers the money in a number of transactions on the accounts. So first of all, he deposits, he places, he introduces it's having to introduce the money into a financial system. He introduces the money into a financial system, for example, by having to deposit in a bank account. Then what he does, he actually moves the money in several accounts. Some of them even offshore. For example, he moves to an offshore account, maybe in China. He further moves the money from China to maybe another account in the UK. Move the money again into another country in Africa. Move the money again into Europe, then back to Asia. Then eventually, he actually brings the money back to Kenya, where, probably in this case, it could be maybe at which bank? You say which bank? Maybe Standard Chartered. Then he actually withdraws the money. So he actually basically does what? He invests the money into very expensive real estate properties. So for example, he puts the money into very luxurious items. For example, cars. For example, this is jewelry. So we will start wondering, so how does this person get money? So how does this person get money? So probably some of them are basically from what process of crime, but that is what they have been able to do. They have cleaned the money. It was dirty money, but they are trying to do what? Clean it. They're trying to clean the money. So that is what money laundering. So across several countries, Kenya included, they have come up with very stringent anti-money laundering laws or policies. So it is a crime that is having to be fought globally. Kenya included, it has laws or regulations pertaining to matters what money laundering. And as far as this case, it is so much of concern to the auditor. Auditors are likely to, for example, be engaged in assignments whereby this client they're having to undertake work for could be involved in matters what money laundering. So therefore, the auditor has the responsibility under the laws to ensure that in this case, if it comes across a client who's actually involved in money laundering, then you should be able to report what to the relevant authorities. So of course, for them to be able to do what? Undertake their own independent investigations. But there's something of so much essence. The auditor shouldn't actually be involved in what we call what? Tipping off. Tipping off ni kumuonyesha signs kwamba ni kama report. So unaweza fanya tu chini ya maji. Then you continue the audit assignment. Because what you should actually avoid is to tip off. You leave the investigative authorities to do what their own independent investigations. So of course you can just be able to see signs. So part of the signs or indicators would be part of the indicators of money laundering is happening in the client you're auditing. Indicators of money laundering. Number one, it could be, for example, they actually unexplained deposits or revenue sources. Unexplained deposits in the bank account or unexplained revenue sources. Unexplained revenue sources. So clients hakuna katika fulani hapo tautu. Anazanga tumasimu lakini fair bank statement yake, so each and every day 3 million is actually deposited. But you look at the sales that are basically done in a day, it's not actually even beyond what maybe 50,000 or even 20,000. So when you try to query where the other revenues that are going to be deposited in the account, there's no proper explanation. So that would be a telltale sign. That's in this case, una pesa inaoshwa. And number two, it could be, for example, there's actually a very complex organizational structure. That is not actually warranted for complex organizational structure. For example, Okaduka, you use a who owns it, wanakwambia who the directors of that shop. UK, wengine wako Russia, wengine wako Brazil, wako sita, wako directors sita, and Okaduka too. So what is the essence of having a very complex organizational structure. So that is also another telltale sign, probably, that it will happen for you. So you can just be able to see the signs, because you can be able to suspect probably there could be money laundering issues happening here. So what you do, you have a responsibility under the anti-money laundering laws to ensure that in this case, you report to the relevant authorities, and of course, don't do what you call a tip-off. You leave them to do what their own independent investigations. So of course, when the says to myself, do I continue the assignment or not? And of course, that one depends upon a number of factors. For example, within your audit firm, if you have a really established audit firm, you can, for example, appoint a person we call an anti-money laundering officer. Who officers are like overall in charge, dealing with such kind of matters when they actually arise. Kwamba auditors wako wameenda wakadiscover huu plan unaweza kuwa wameona hizi signs, so wanakuja wana report kwa AML officer audit firm, and assess and our guide is how you can go about it. So this anti-money laundering officer appointed is the one who will be able to formulate procedures. As far in this case, for example, auditors from that firm, when they go to audit such kind of plans, how they can be able to go about their work. You can also, for example, be involved in formulating training manuals or training guidelines. As far in this case, whenever the auditors from that firm come across such kind of plans, how they can be able to go to maybe undertake their work. So the auditor has a responsibility to do what they report. In a case, for example, he has suspicions of money laundering happening within the client business operations. But avoid what is called what tip-off. Some of the signs you can be able to look into are, for example, these ones. And of course, you can put in internal mechanisms within the audit firm. For example, appointing an AML officer who can do, for example, oversee such kind of exercise of having to deal with maybe such kind of plans. Or further to that, you can do, for example, ensure before he actually onboards any kind of plant, anafanya kitu inaitwa customer due diligence. So customer due diligence wanamuuliza, for example, kama client wetu kwanza kufanyia audit, unafanya biashara gani, unafanya biashara kwa auto, who are the directors, who are the business, do you have any other, for example, in this case, businesses you would have invested in. So after the understanding of the client in this case, can also be able to enable the auditor to know how in this case he can be able to identify this kind of plans, and of course know how he can be able to deal with them. So money laundering is a process by which a criminal attempts to conceal the true origin and ownership of the proceeds of his criminal activity. By doing this, you can be placing, layering, then integrating it back to the economy. It's always, it is a way in which money earned from criminal activity, that is dirty money, is transferred and transformed to appear like it has come from what? A legitimate source. It is clean. So offenses of money laundering that could be committed by accountants, for example, if an accountant or maybe an auditor handles the proceeds of a criminal activity or advising on the use of such kind of proceeds, and then failure to report knowledge of or suspicion of money laundering activities to the appropriate authorities. Failure to report, lazima report the relevant authorities, making disclosure which is likely to prejudice an investigation to money laundering, tipping off. Anaonyesha signs kwamba amereport, so ana investigate your plant, so afai kufanya hivyo. Then failure to comply with specific regulatory requirements in relation to money laundering. As we're saying in this case, a number of jurisdictions, so across the world, these are very serious violations having to be fought by several countries. So they have anti-money laundering laws that have to be observed. In that case, the auditor does anything contrary to that law, then he will be responsible. So the policies and procedures to be carried out regarding money laundering by the auditor. Number one, as you are saying, appoint an AML reporting officer. So anti-money laundering reporting officer. And then you can be able to do what you call customer identification procedures, or know your customer first before having to onboard them as clients. Then number three, communication and training the audit staff so that they are aware of money laundering regulations and how to identify money laundering issues. The number four, risk assessment and actually monitoring. So having to undertake risk analysis of plans before, in this case, they can actually continue to undertake the work, and along the way, they can always, basically, for example, in this case, be doing the KYC each and every year. KYC each and every year. Know your customer each and every year. So they call upon all the clients whom they have been able to serve. If they provided their details a year ago, they have to provide again. Probably in this case, they could be things that have ended up having to do what maybe change. Maybe in terms of ownership of the client business operations, whereby they can be able to understand that in this case, what is currently having to do what happens with that. Then of course, they can be able to do what maybe handle those plans are actually involved in matters what money laundering, matters money laundering, matters money laundering. So we can take a small break. And so this will break like 5 minutes.
Kwanza asubuhi nilikuwa nasikia nalala, but nilikuwa nasikia usingizi. Kwanza ni Friday hadi pia hiyo accumulation ya fatigue. Rauka. Hiyo watu. Na kesho tunampira. Kesho anashikilia tusimuogopi mwalimu. Tunafanya simu. Sisi asubuhi tushafanya ifaa. Sio vile. Nasikia hiyo kitu ya ifaa. Mwalimu. Mwalimu tuna njia zake. Mwalimu Kiongo. Anasema tutakuwa tunafanya na hiyo system ya ACC. Mimi asinifunze hiyo kuandika mtihani wa ACC. Kwa tunafikiria tu much. Tuna overthink. Do ACC wanaletea maswali zingine. Kuna kazi hapa remote. Jesus Christ. Nafanya kazi za remote. So long it can kuna notifications vinga hivi. Sio tufanye sana. Usiku. Sisi za UK. Na kusoma data kusoma sana. Wait, tell kwambi I watch sana. Si watch bila sawa watch.
So ni wiki mbili za mwisho.
Sisi kwa wiki mbili za mwisho tunanipa challenge na vitabu za revision. Mimi hata siwezi hapo system ya kuwatch nikikumbuka. Kumbuka hapa. So financially.
Sasa kuna vitu unajua tu ni lazima zikuje kwa mtihani. Kusoma hizo kama
hiyo publish.
Nika hiyo kwa family ya mwisho kitu public content. Lakini kuna swali kama hili kuji. Lakini ilikuwa income statement.
Citizen.
Ilikuwa income statement na balance. Sasa hiyo huwezi shika kubasa kupatia.
Hiyo topic katika kwa
muziki sawa.
Inaonekana experience. Sina kama body.
Unajua kusoma ndio peke yake.
Inataka 5 years experience.
Unafanya hesabu au tunafanya bila siwezi sikia. Unapata.
Ndio hesabu zinakuwa. Unataka sio kitu na hesabu. Sawa, theory kusoma kama hii.
Nasikia mkao.
Watu ambao wampendi kusoma theory kama mimi. You're done for 16 topics.
Hizo bani. Zinafanya sahihi karibu kila kitu.
Kina district kwa nini? Kina district. Sini hapa. Ni hapa. Baadaye nyingine kizunguke. Sawa, yanatoka. Sipenda tu kunipigia simu na anipei pesa. Anapiga simu mbona? Anipigia kama ni class.
Na uje nifike kwa nyumba nimgombanishe. Mwambie mzangu mtu kama anapigia mtu simu ni nini sasa? Pesa hapa ni job. See, I know. Asaina date ya masomo. No way. No way. Kwanza nataka tukosana niambie tu.
Unaiangalia ikiwa negative. Kingine kitu nzuri. Maua unaletoa maua Friday.
No. Acha niingie Twitter kwanza. Tuko na fursa ngapi?
Twitter.
Kwani ni join lini?
Mimi nataka tu.
Guys. Lakini Twitter tangu patie followers. Twitter si ya
Nilikuwa naitumia kitambo siku hizi.
President of US.
We're not talking about warembo. Guy, mbona natupeanga huyu mwingine tu anadunishonisha huyu mwingine na acha warembo warembo. Kama si wanechu.
Kwani hao wengine ni warembo?
Ni just funny. Wasichana tena na wamamgoza tu si wakiwa au watatu wako na mwingine tena.
Kuliko
Shalini Ruto. Shalini na Kenya huyo ndiye anatuonyeshanga lakini wasema yake wanasoma sana.
Akina wengine mbona
Stephanie warembo. Awakaika Ruto ni warembo. I'm telling you that very beautiful.
juu Shalini ndio anataka kama Rachel.
Anatuambia no, she's not. If you sema na sister zake I swear. Pia ni kama angekuwa tu mwanaume.
Na nikuulize hao watoto wengine hawasomei
walisomea hapa Kenya lakini wakaenda wapi? I can't wait to leave this country. I'm suffering here. Najua jana sister ni surprise hapo. Alafu mimi na kitu zangu mingi like thinking. Nikienda online search transaction kwanza. Mimi transact pesa ngapi? So nikaenda kucalculate. Hapo nikaona ni kama check hapo ndipo tunaanza pesa kama niko kama pesa mingi. Hicho ni jewelries. Hivi naona ni kama wananichezea. But 25 pence they get for a really long time.
sasa okay.
You only have one sister. Jalipa. Nafanya shopping.
Sasa kuna kulipia rent na nakufanyia
Hapana. Hapana. Anasaidia pesa dogo kama nimdanganya yani. Ninadanganya acha nikwambie mimi nijiambia hii Nairobi. Siwezi kama msichana mimi natafuta sponsor. Nitadanganya wazazi mpaka wachoke na mimi. Siwezi tafuta mmoja. Tulikuwa na msichana mwingine university. Hata alikuwa anafanya assignment zake na tulikuwa na pesa za wazungu. Ameulika kwa mzee sikini ananionyesha picha nimeisha. Hata sikumwambia kitu nianza kucheka kwanza. I couldn't hold on.
na unatumia wazazi sasa but now years something like 20 years later sasa wao watakuwa dependent.
Mamangu aliniambia hataki mtu
unless ako na retirement nani
sasa atakuwa anakula pesa yake ya retirement na hana wajukuu wa kusumbua.
Nasikia kwa mgonjwa za pesa ngapi wewe
na atakuwa ushago
sasa anataka kufanya sijui
alafu babangu atakuwa
anataka kwenda kwanza wako vile sasa kuna excursion na huko kwambia wanataka kwenda
vacation. That is my dad, not my mom.
Pesa yetu hata kurudisha vacations
tangu
nishaanza mindset ya vacations
tangu kwanza kuuza watu wengine mkubwa wangu before nifikie sitakwenda pesa kidogo
sawa
lakini mimi nilijiambia nilikuwa na mbele mbele zangu mimi nitafute hiyo boyfriend mimi lazima nidanganye mzazi mpaka nilikuwa namdanganya tunaenda kupitia accounts wewe unasema mimi mamangu sikia niambia na kuna nidanganyanga lakini ni sawa tu Unajua naweza kazi. Lakini leo mama akikasirika you know the go in her.
Na kwanza unajua mama yako ni mwalimu.
Anajua
Teachers are strict. Sana mama strict. Kila kitu anapaswa.
Kama alikuwa anakuja kuona tunaishi campus. Na hata niambia nilimwambia siku moja utakuja hivyo kabla tupate mwisho na kuenda kufanya. Mimi nipate kini mimi nanipa rate. Lakini nimaliza life cycle za loko kwa mwalimu.
Walimu hawakujangi. They're so strict.
Kwa siku ile nilienda na viatu yangu na nimeongea kabisa pia tumetoka wapi? Nitaanza kusema mimi bora ndio wale tunauliza kama wanaume. Ukienda kwenye msako kuzaa utauliza kwa nini? Akasema sikuta mzazi kama huyo. Nategemea. Someday for the first time ndio ukienda usikwenda unauza shamba my friend. Leo muuza shamba ndio mwalimu alikuangalia tu. Mwalimu ni mkuu.
Ndio mwalimu mzuri.
Ndio
Anakaa kuwa mshafu.
Lakini college.
Ana story.
Story zake ni funny.
Na nikiwa
Hana story hiyo, basi akileta hiyo story. Utacheka mwisho. Yaani hiyo story anaitoa inaweza inakaa smart.
wewe acha hizo bwana. No. Na record ni tutakata.
So unaona kama jana alikuwa anasema hivi ati sasa ni kampani ndogo. So tulikuwa tumefika topic ya member.
Unasoma online?
Si physical. Pangapi? Si during the day kama jana class ilikuwa afternoon.
Mmefika wapi?
Sasa ndio nakwambia jana tulikuwa tunasoma membership register of members. So you can be a member at the same time when you share work. So kuna exemption. Sasa kulikuwa na exemption ya doctrine and of so nasema in that doctrine your name can appear in the register of members of company by mistake. So wanasema sasa hii point ilikuwa very funny. Ati sasa unajua hivyo hiyo kampuni hawajui. No one knows but wewe ndio unajua. So sasa una enjoy the privileges of being a member. So kama ni dividends unachangamkia. Ati kama ni sasa hizi meetings members wanafaa kuattend. Unaenda kwa hiyo meeting, unapiga kelele, unapitisha voting rights. Na wewe unajua
ingine ile ni ngumu sana kidogo hivi.
si ndio nilikwambia. Bila class ilisha nikamwambia Aisha mwalimu hiyo scenario normally happens. Ati dividends zikitangazwa changamkia. Kwa sababu mbona vile alikuwa anasema
Chakota kwa kampuni
imagine by mistake. Na unajua hivyo. Unajua huku umebuy shares.
Kuna financial accountant job kwa Kenya Airways.
So we can look at the code of professional ethics for accountants, the code of professional ethics for accountants, or the principles to be observed by professional accountants in their practice. Professional ethics for accountants, the principles to be observed in the code of professional ethics guiding the accountants in their work. So we have discussed the code of professional ethics. Professional accountants, for the principles to be observed by these accountants, the auditors in their work. So IFAC is an international federation of accountants. It's an international non-governmental non-profit making organization whose members are countries that subscribe to the international accounting and auditing standards. So international ethics standards board for accountants has the mandate of developing and issuing professional code of ethics for practicing accountants globally. The professional code of ethics in the form of fundamental principles and other guidelines which professional accountants should observe in their trade when they are having to practice or provide their services. So these principles we have to talk about in this case, then we're talking about integrity, we're talking about objectivity and independence. Objectivity and under objectivity you can add the objectivity and independence. And the one there and independence. Objectivity and independence. Objectivity and independence. We have confidentiality. We have a professional competence. Professional competence. And professional behavior. So that these are the big ones. So objectivity goes hand in hand with independence. Independence has been listed amongst the others, but they actually call and it has. So we talk about integrity, then it simply means you should be an honest person in your undertakings or a straightforward person in your undertaking as a professional accountant. So that is what we mean by integrity. So you should be a truthful person. So you shouldn't actually be involved in having to tell wrong information or tell lies. So professional accountants should be honest, straightforward in all their business and professional relationships with their clients. So they should demonstrate high levels of integrity and honesty. Objectivity: a professional accountant should be fair and should not allow any form of bias, prejudice, conflict of interest, or influences of others to affect their professional judgment. So ideally, they should just be independent, not having to be influenced in their professional judgment. Confidentiality: you need to be confidential in terms of having to keep the information you would come across when you're having to audit the reporting entity or maybe the client. Because in this case, you get access to a lot of information, especially financial information. So you shouldn't reveal or release that kind of information to any party or any person. In this case, you've not been authorized, or maybe in this case, circumstances, exceptional circumstances, have actually called upon you to, for example, reveal such kind of information. So we have in this case confidentiality. A practicing accountant should respect the confidentiality of the information obtained in the course of providing what a professional service. It should not disclose any such information to a third party without the explicit permission of the client. So, but of course, in this case, under exceptional circumstances, you might be forced to give that information. So, for example, in a situation where the auditor finds it is reasonably necessary to defend himself, anataka kujitetea maybe kwa koti, maybe hiyo liability tumeongelelea imetokea. So, kuna kitu mtu ana blame kwamba ako liable, but akona evidence. Part of the evidence is that part of information is gathered from the client. So you can basically use that kind of information, for example, safeguard or maybe protect himself in a court of law. When giving evidence in a court, when the information is required by regulatory authorities, for example, alikuwa na audit bank. Sasa bank wameitisha nini? Wameitisha audited financial statements. Central Bank of Kenya wameitisha, CBK regulates banks. So wameitisha audited financial statements of what? Of a bank. So an option atatiana. Some people have been auditing maybe a company, so they want to remit their final submission returns or returns. So the authority basically needs the audited financial statements before they can, for example, ascertain the competitive in terms of what the tax is. Maybe the information is required maybe by ISPAC or where the auditor knows or suspects that the client has engaged in an act that are prejudicial to the public interest. He has a public responsibility to report to the relevant authorities by giving out the information regarding the client. So importance of confidentiality, in this case, it actually tries to also, when you ensure that there's actually confidentiality with regard to the client's information, then you enable the client to keep his business secret. So not a lot of information about the client will be out there. So you get access, an auditor gets access to a lot of information concerning the client or maybe reporting entity. So if he actually practices confidentiality, then this client is likely to safeguard his business secrets. Then in order to form an opinion, the auditor must work closely with those who prepare the financial statements. But of course, to gain their trust, then he must be able to ensure that the information is actually given. And in this case, he keeps it to himself, so that in this case, he can be able to gain their trust to get more information from them. Then it is one of the fundamental principles of the code of ethics. That in that case, you actually breach, that would be like a professional misconduct. And for example, in this case, maybe your practicing license can actually be revoked. So the duty of confidentiality is not absolute, and there are also maybe exceptions, so as we've been able to see. So auditors have no legal duty to report illegal acts. They have no legal duty to report illegal acts. Then we have professional competence and due care. That in this case, as you conduct your work, you need to be able to deploy highest levels of what? Showing your professional competence. This simply means your knowledge, know-how, skills, and actually expertise should be demonstrated and actually deployed in your work as an auditor. So you cannot take your work professionally. So professional accountants should perform professional services with diligence, due care. He has a professional duty to keep himself updated with what the current developments. So it's actually a continuous development process, whereby if there are any form of changes arising with regard to the profession, then you should be able to update yourself to still remain relevant and actually competent. So the importance of professional competence and due care, the auditors are contractual obligation to carry out the work with reasonable care and skill. It enables the auditor to express an appropriate opinion. So you demonstrate high levels of competence, you carry out your work competently by deploying all the knowledge you have, the skills and expertise and experience. Then the kind of opinion you end up having to express is likely to be the most appropriate one. Then he has both the legal and ethical duty to employ reasonable care. So he has no option, but he has to do it. Then whenever auditors are called upon an inquiry, i.e. made suspicious, they have a duty to investigate the issue to the bottom to obtain reasonable satisfaction regarding the truth and fairness of what the financial statements are. Of course, what can end up having to happen or help them here is ensuring that in this case they fully undertake their work professionally. Then it can end up having to minimize or enable the auditor to avoid any form of liability. As you've been able to see how liabilities end up having to arise, is when in this case you don't actually, for example, deploy experience and expertise in your work. In terms of you yourself as an auditor, for those ones who are having to work under you should be persons who are actually very experienced and they're actually very competent with that. Then the importance arising is that you'll be able to minimize any form of liability having to arise. And then professional behavior, so you should be able to carry out himself as a professional accountant, consistent with the good name that comes with what? The profession. You should avoid any actions that may discredit the name of what? The profession. So any name that will end up having to discredit or put the profession to be good in a bad image. So you should actually be able to avoid such. Maybe in this case you are the lead accountant who's actually known all over the country. But in this case, the kind of activities you're actually involved in, so it dents the public image that comes with that particular kind of what may be a profession. Let's say, for example, in this case, the chairman of this currently is actually negatively portrayed in the news because of what his actions. So you can imagine what in this case will be viewed of the profession. So in this case, the lead accountant, for example, be involved in such kind of activities. It simply means that all accountants are very useless people. So if that is the case, that is having to do with discredit the trade or maybe the profession. So you should be able to safeguard the name or the image of the profession by behaving professionally. So other professional guidelines, which are not likely, for example, majorly under the code of ethics, but you need to be able to observe them. So changes in professional appointments, we have obtaining professional work, and now you can be able to undertake advertisement, and of course independence. So changes in professional appointments. So a professional accountant in practice should respect the right of the client in choosing whoever they want as their auditor. So when a member in practice is nominated as an auditor, he should seek permission from the client that he may communicate with the outgoing auditor. So sometimes there could be changes in terms of the auditors of the client or the reporting entity. So what will end up having to happen here, it is that if you want to communicate with the outgoing auditor, maybe you want to get more information from him, or maybe you want to take over the audit, then you can seek for that permission from the client. So once he gives you the permission, you can be able to proceed and act, for example, gather any information you feel will be relevant from the outgoing auditor. Maybe you want to understand the client. The auditor has already been there, has the experience. So atakuelezea hii audit nilianza hivi nikafanya hivi, this is what I came across. The management are people of integrity, they're like this and this is how we can go to go about it. So that essence of having to reach out to the outgoing auditor is very important. And therefore, in this case, you can seek for that permission to communicate with the outgoing auditor. If such permission is declined, the auditor should do what? Decline or maybe reject what? The appointment. Then if the permission is granted, the auditor should request in writing of the outgoing auditor of all the information that he ought to be made known to him. Then on receipt of the request, that outgoing auditor who has left should first seek permission from the client that he may communicate to you freely about the client's affairs. If the permission is declined, then the appointment can be declined by the auditor. Then how do you obtain professional work? How do you obtain what? Professional work. So how do you, for example, in this case, seek, how you can end up having to get what? Clients. Clients and party. So a member in practice do not comply to a request to give a fee quotation to a company that is not a client. A member in practice shouldn't obtain professional work for himself or for others in any unprofessional manner. He should not give a commission, a reward, or a fee to a third party for introducing him to what? To a client. So he should basically, for example, follow the right procedures in having to obtain, maybe in this case, professional work. For example, if it is many government agencies, there's that what we normally call what maybe tendering process. So the right procedure should actually be followed. But in this case, we end up having to wonder, for example, in Kenya, I don't know if that is what normally happens. So in government agencies, one, for example, in this case, provision of audit services, for example, it could be called upon to undertake an audit on CDF of a particular constituency. In this case, you want to take an audit on a particular government agency. So majorly, they normally do what we call what tendering. But in most instances, what normally happens, the auditor ends up having to win that particular tender. You might end up having to realize that there was a lot of what pollution. So even though we are having to say here that you shouldn't actually do such in obtaining your professional work, you should actually, for example, follow the due process. So that's what is actually you are called upon. Then what happens with regard to advertising? Can you be able to advertise maybe your audit services? So of course you can be able to advertise, but of course now in this case, you must be able to, for example, follow the set out rules or guidelines in the jurisdiction you're having to operate in as an auditor. But overall, or maybe generally, as our auditors would end up having to advertise their work, we should be able to ensure that in their advertisements, they shouldn't give any form of disparaging remarks against any other audit firms. For example, having to indicate that you are the best audit firm, basically provider of professional accountancy services than any other audit firm like maybe XYZ. That simply means that in this case, you are giving what disparaging remarks against that other professional accountant. So they should actually avoid such. So a professional accountant in practice should not advertise their services directly to the client. However, advertisement in paid media is permitted on the following grounds. When seeking for staff, you cannot advertise you're looking for staffs. When acting on behalf of the client, acting in a fiduciary capacity, advertising for a subcontracting work, or we can be able to do what we call paid announcements in the media are permitted for the following purposes. For example, if you are opening a new office, changes in the membership of the audit firm, changes in the address of the audit firm. For example, they are changing location, or members' appointment. A member's appointment, we've done any form of appointment in the audit firm, then you can, for example, make such kind of what announcements. And in that case, for example, you maybe advertise for your services as we're indicating, then you must be able to follow the regulations, maybe the jurisdiction or country you're having to operate in. Then you have independence of the auditor, which you try to emphasize together with objectivity. Independence simply means that you give an independent opinion about the client business operations, the client financial statements, without having to be influenced by any party. So utafanya tu hiyo kazi independently and you give an independent opinion. No way in this case, for example, the client himself, the directors of the reporting entity can influence you. But in this case, you are called upon to be independent, giving an independent opinion so that in this case you can observe or enhance what you're calling objectivity. Independence is essentially an attitude of the mind characterized by objectivity, integrity, and professional skepticism in approach to professional work. An auditor must be and must be seen to be independent, meaning that independence is exercised at two levels: independence of the mind and independence of what appearance. Independence of the mind, in fact, this is the state of mind that permits provision of an opinion without being affected by influences of others, prejudice, or bias that might compromise the professional judgment. So you are doing the work, you're basically deploying your professional judgment. You're just deploying your professional expertise, experience, and knowledge. Nothing else should end up having, for example, in this case, influence you. Nothing else should actually end up having to influence you. As what in this case you are called upon as a professional is what you're supposed to do, what maybe deliver. So no one should be able to sway you to do the contrary or to go the contrary way in terms of having to do what maybe express your opinion. This one will end up having to lead to what you are calling biasness. It is the state of the mind that enables the auditor to act without allowing any bias, prejudice, conflict of interest, or influences of others to override his objectivity, integrity, and professional skepticism. Independence in appearance. This is the avoidance of facts and circumstances that may cause what a reasonable and informed third party to think or suspect that the auditor or audit firm's integrity and professional skepticism has been compromised, has actually been compromised. So you basically carry out yourself as an audit firm. You should actually basically in a way that any third party should not actually go to get any form of indication. Probably in this case, your independence as that one has actually been compromised. So there's a term there that is having to be introduced there. So professional skepticism. They're saying it is the state of the mind that enables the auditor to act without allowing any bias, prejudice, conflict of interest, or influences of others override his objectivity, integrity, or professional skepticism. Professional skepticism, in short, we're talking about having what you call a questioning mind. Having what you call what a questioning mind. So in most instances, we will end up having to say auditors ask a lot of what questions. They'll end up having to ask a lot of questions. So this asking of a lot of questions actually enhances their objectivity, So, and of course, this one will actually be deployed throughout the audit process. For example, in this case, when you're having to be engaged by the client, you can be able to ask more questions just to be able to understand this particular kind of a client and his environment and which is having to operate from, is actually having to operate from. So this code of professional ethics we've been able to talk about, sometimes you could end up having to face a challenge as an auditor to be able to observe them. So therefore, we have what we call threats to the code of basically compliance, threats to the auditor's independence and compliance with what the code of professional ethics. So there are 5 of them. Surface. There are 5 of them. Surface. So you have self-interest. You have advocacy. You have familiarity. You have intimidation. and we have self-redeem. 5 of them, known by the acronym SARFIS. So self-interest threat, advocacy threat, familiarity threat, intimidation threat, and self-redeem. So these ones are likely going to hamper you to be able to observe this. And remember, hizi ni kama regulations or rules unapofuata. Sababu usipozifuata, it simply means that you could end up having to not be allowed to do what you practice. So you must find a way as to how you can be able to deal with this kind of what threats. So that in this case, at all times, you can try your level best to do what to observe the code of professional ethics and actually what independence. So when you talk about in this case, for example, self-interest threat. Self-interest threat, it simply means that you have another interest in the reporting entity. You have another interest in the reporting entity. For example, in a situation whereby you are going to be the auditor of a company or a client, and at the same time, probably you are a director there. Maybe in this case, you are a shareholder there. It simply means there's another interest that is actually there within the reporting entity. So will you be able to do your work objectively or independently? It will be very difficult because now in this case, it's like in this case, you are just basically going to audit your own business if you are a shareholder. So you won't have, like in this case, that independent mind. You'll actually basically be influenced. You'll actually be hampered. It will be very difficult. So self-interest threat arises when the auditor has financial interest in the client company. It arises where the auditor has a beneficial shareholding in the client company, holding more than 5% of the total share capital of the client. So wewe ni shareholder bado hapo kwa hiyo kampuni na bado unaenda audit. So it becomes a bit difficult. So there's another interest. You have a financial interest in the client. Over relying or undue and independence of the client for professional fee. The auditor is drawing more than 15% of the professional revenue from what? The client. And we want to client to take the mayor. Revenue in a part of the whole year, for example, contributes like 40%. 40%. So there's another interest you have. So you don't have, for example, in this case, kukosea your client. Kukosea, for example, ukijaribu kumwambia umepata kwa account hizi ndio vitu zimefanyika, anze kupiga kelele achana na theory, you will lose this particular kind of what client. So you have another interest in terms of what over the lands of the audit fee. Significant business association with what the client. Maybe this client could be a major customer, or you are in this case a major supplier of the client. So I'm supplier goods to zingine. At the same time, I'm a bidder to the audit. So there's another interest you already have there, whereby you're expecting some money from the client. So if he doesn't, for example, do as he wishes, for example, after to pay your order to supply. So there's another interest already you have there. Or for example, a loan, you have loaned the client, or ama amekupea a loan. Already you have another self-interest there in terms of what the loan. Preferential terms of trade from the client, e.g., undue hospitality. So I could treat this much. So ukienda kufanya audit for your client, unapata kushakutengenezea chai, samosa, mandazi, kitu inaitwa hapo. So with a lunch time, for lunch. That's giving for dinner of the client. So you are basically fearing this kind of gifts. You end up having to not be there. You do anything contrary. So it simply means that there'll be a self-interest rate having to arise, whereby you end up having to fear you lose that. Contingency fee, where your fee is dependent on what? On something. So whereby anakwambia ukinifanyia hivi na hivi na hivi na hivi kwa hiyo audit report, nakupatia 3 million on top of that audit fee you reported. So there's another interest you have with regard to what you're having to undertake as what? As an auditor. So that basically hampers what? Your independence and what? Maybe objectivity. But then we have advocacy. Advocacy is whereby in this case we act like, you know what advocates normally do. So they normally defend what the position of what their client. So you can find yourself in a position whereby in this case, it's like you'll end up having to protect or maybe safeguard the interest of the client. Let's say, for example, in a situation whereby we call upon to maybe carry out an evaluation of the cash flows of the reporting entity. So these cash flows, you'll be able to prepare a report about them, whether in this case they are true or not true. And of course, they relied upon maybe by a bank. They can be relied upon maybe by the bank to do what? Maybe to give a loan. So client anakwambia nataka kienda hiyo committee ya approve your loan, nataka twende na wewe. So probably what he wants you, for example, to do there is when the questions are raised about these what cash flows. Before the loan is given, you defend the client. Simply having to say, probably these cash flows are actually very correct. Maybe this case they put it accurate, maybe it's so accurate, but he just wants you to do what? Act like an advocate having to defend what this position for him to be able to do what? Maybe get the loan amount. So we can be able to have what we call what advocacy. So I think we'll end that. We'll go to wind up in this other area in our next class. But of course, we can just go to at those other ones. We have familiarity, self-interest, self-review. Those implementation, you can see how they actually normally arise. They normally actually arise. So we'll be able to wind up in this area. And then I think we'll start. So you can end it and then we get the register.
Do we have mathematics in this? Yeah.
Let's start.
Sijaanza kusoma company law. Mwalimu wangu ni mgonjwa. Hamtanisaidia aje?
Sikuja classes zetu zitakulia na online.
Very online. Really run. Just
But audit is wide.
The audit is this one is wide, 16 topics. 16 topics.
Madam,
Nasilalani kwa mata, mtoto shua leo nikiingia kwa hiyo mata, nitakuwa naniongoza. Asili
Somo nilikuwa nasema kwa mtu kwa
Unajua ile malimwanga nilikuja na usiku sema kaniambia kuji. Bado ni usiku.
Sasa utafanya aje sio mwalimu? Mko which topic?
Hatujaanza.
Right.
Si yule mmoja.
Tunamaliza Mei. Mbona kwa hivyo?
Mimi naanza May classes.
See, like tunamaliza Mei. So you see, you have June, you have July, you have Manilopia. These are my case flows.
So it is.
It's a good teacher. Kuna vile atacheza kama yeye.
Tunafanya commercial ya unit hiyo kabisa. Sasa hizi ni ana business school. Hiyo ni shiko. Yake ni shiko. Alikuwa
Nasikia business school unaogopa. But nilikuwa najisomea siko naenda class. So kwa vingine nasoma, kwa vingine nasoma aje. Nilishikwa kushikwa more than 3 times.
ati na ukarudi.
Nilienda kuapply transaction.
Kwa nini?
Sasa nilikuwa nashika all the time na ninaishi hapo. Haupiti na usipiti. Siendi class.